Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday, the 2nd of November 2023. And yesterday we saw the FOMC of the Federal Reserve not only refrain from raising the Fed funds rate from its current level of 5.25 to 5.5%, but also providing a rather dovish tone, leading some analysts to believe that there will be no more rate rises from here on. Are they making the right decision? Let's take a look. Now, before we look at what happened to interest rates yesterday and interest rates today, just a quick reminder, we have set up a second channel entitled Finances Do Matter, covering a whole array of financial topics. We've placed a link in the description box and comments section below for those who have not as yet joined that channel, which we strongly urge you to do. Okay, yesterday, the FOMC met and decided not to raise interest rates, though Fed Chair Jerome Powell did point out to reporters that decisions will be made, quote, meeting by meeting, unquote, and noted the committee will have an abundance of data, including 2 employment reports and 2 inflation reports, as well as more data on financial conditions and geopolitical risks before December. Now, the reason he mentioned December is that their next meeting is due on the 12th and 13th, with announcements to be made on interest rates again on the 13th of December. Now, Powell's comments and the FOMC statement certainly appeared rather dovish, especially when Powell added the following comments, quote, "The question we're asking is, should we hike more? Slowing down is giving us, I think, a better sense of how much more we need to do if we need to do more," unquote. Now, in a post-meeting statement, officials stated that a recent rise in longer-term Treasury yields reduces the impetus to hike again, though they left the door open to another increase. Now, the result of these announcements were a 1% rise in the S&P index and the 10-year US Treasury yield tumbling below 4.7% for the first time in 2 weeks. Futures, though, were pricing in roughly 1 in 4 chance of another rate hike by January, compared to around 40% chance the day before. Now, for equities generally, this was indeed good news. The Dow Jones closed up 0.67%, the S&P 500 up 1.05%, and the Nasdaq up 1.64%. Asia stocks overnight were broadly up 0.5 to 1%, and UK and European stocks are up 1.25 to 1.8%. Cryptocurrencies also rose, with Bitcoin surpassing $35,000. At the time of writing, gold has risen these last 24 hours by $5 and currently stands at $1,989, and silver is up 37 cents, standing at $23.06. Both, however, are still a little lower than last Friday's close. The dollar index has weakened, though it still hovers marginally above 106. We have crude oil up a little at $85.90 and WTI crude at $81.72. So, where are we going from here? As far as the US is concerned, it's interesting to note what top financiers are saying. For example, JP Morgan boss Jamie Dimon told Yahoo that another 75 basis points of hikes are still possible, while ex-UBS chairman Axel Weber said he sees another increase in December. Now, we've stated all along that the Fed should have quickly raised rates to 5.5% to 5.75%, and inflation would have been tackled much more quickly. Now we can probably expect a long, drawn-out process. Even if rates do not rise further, they will remain high for longer. Now, today, the UK's Bank of England is announcing its decision on interest rates, and most analysts predict that they're not going to be raised. The current benchmark rate is similar to the Fed funds rate at 5.25%. The Bank of England believes that the UK economy will stagnate next year, though, which is hardly surprising. Going back to the US and supporting a video we produced earlier in the week entitled "Property Crash Ahead, Gold and Silver's Opportunity," we put links below, aggressive Fed tightening has driven the 30-year mortgage rate to an almost quarter-century high. But this hasn't so far caused prices to fall as homeowners cling on to their existing cheap mortgages. The problem is, of course, is when that duration runs out and they have to remortgage. A stubbornly strong economy threatens to keep mortgages expensive for years, though. Modestly cheaper loans would only unlock pent-up demand, sending prices even higher. And an economic collapse that might bring rates down faster would also make buying more difficult. What does not augur well in the US is the result of a Bloomberg report from a survey of 11,000 adults that if they were faced with an emergency expense of $400, 34% of those adults would then not be in a position to pay other necessary bills. That in itself is quite worrying. Now, while writing this video, we can confirm that the Bank of England has just made its decision on interest rates, and it's held its base rate to 5.25%. 6 members of the Monetary Policy Committee, which makes the decision, voted to keep the rate the same. The other 3, though, wanted an increase. I would have been in support of an increase too. Alongside the interest rate decision, the bank has also downgraded growth forecasts for the UK economy. It expects growth of 0.6% in each of the last 2 quarters of 2023 compared to a year earlier. But it says growth will fall in the first quarter of next year to 0.2% and then on to 0% in the second quarter and beyond. At least you've got better growth rates envisaged for the United States. Governor Andrew Bailey has said higher interest rates, quote, are working to curb inflation, but we need to see inflation continuing to fall all the way to our 2% target. We've held rates unchanged this month, but we will be watching closely to see if further rate increases are needed. It's much too early to be thinking about rate cuts, unquote. This clearly means, as in the US, interest rates are likely to stay high for longer and could rise again despite official forecasts that the UK economy has entered a period of stagnation. This respite will help markets, but as they factor in either the potential for higher rates later or limited economic growth, any hike up may prove to be short-lived. Meanwhile, we believe, certainly as far as gold is concerned, its price will be underpinned, though silver short-term may face a hike as well, but could potentially be damaged by any fall in economic output, with around 50% of its demand being linked to industrial use. We should not forget either that the precious metals are also being underpinned by the Israeli-Palestinian conflict, and so there is a price premium at the moment. And when this eventually subsides, this conflict, that premium may come off existing prices. But for now, though, we are reasonably confident that they will hold their own at least until December, and if there's no rate rise then, we will certainly see precious metals rise, as it typically does, moving into the start of a new year. What do you think? Do you think rates will continue to rise? Have we reached the peak? Will gold and silver prices and equity markets follow through and continue to go up? Do share your thoughts. Meanwhile, thank you for listening. If you've liked this video, please give it a thumbs up, subscribe, press the bell sign, and don't forget, once again, if you haven't done so, subscribe to our Finances Do Matter channel. Till our next video, stay safe and become or remain prosperous.